Hello, my name is John Seguin. Before leaving the exchange in 2002, this was the view I had from my desk outside the 30-year bond pit at the Board of Trade. In 1983, I was on my way to becoming a high school teacher and baseball coach after graduating college, when I was offered a summer job as a runner at the CBOT. My first day on the trading floor was shocking. There were brokers and traders screaming and jumping in the trading pits. There were phone clerks emphatically using hand signals to enter orders in the pit for brokers to execute. Then the brokers' assistants were flashing prices and amounts back to the phone clerks, who would confirm filled trades to clients on phones. Meanwhile, runners pushed their way through crowds to check those trades. To me, it was absolute chaos. Within the first hour of my new job, I remember being shoved from behind and told to move my ass. It turned out it was a woman about half my size with a stack of orders in her hands. This place was terrifying and exhilarating, and I loved it. Obviously, I never did take that teaching job and have been involved in futures markets for over 30 years now. After all these years, this industry still intrigues me because every day brings on new challenges. There are many technical tools such as bar charts, candlesticks, and point and figure charts, to name a few. There are mathematical theories or approaches such as Elliott wave, Fibonacci retracements and extensions, and Gann theory, to mention a few. And there are seemingly endless indicators like stochastics, moving average, convergence and divergence, Bollinger Bands, moving averages, and the list goes on. But after much research and trial and error, Market Profile became my tool of choice. Market Profile is a technical tool that organizes the price activity or auction process into bell curves. Many technicians believe Market Profile is no longer a viable tool now that most markets trade electronically around the clock. And I agree to some extent. In fact, I no longer use Market Profile, but I do believe the logic behind the tool transcends time and allows a trader to adapt to ever-changing market conditions. MacroGraph is a derivative of Market Profile. The original daily profiles are constructed by assigning a letter to each 30-minute period of the day, which are then stacked on the x-axis to exhibit time at price. The thought being that the price with the most letters would indicate which is the fairest or high volume level. Profilers believe that time plus price equal value. As a result, we can determine high volume prices and fair value areas using time as a substitute for actual volume. Let's take a look at how macrographs take shape. In this example, there are no letters in this profile, but time at price is tracked by displaying an orange box for the high through low for every half hour of the day. This profile shows the high volume price comes in around 42.92. I have found that using 30-minute periods and actual volume to construct bell curves form very similar, if not identical, structures. In this chart, each profile is shaded a different color to distinguish days of the week. Much like letters are used to distinguish time in the daily profiles, I use color to separate time frames in longer-term bell curves, or macrographs. Like most other tools, open, high, low, close are shown, but with bell curves, or what I sometimes call bar bells, high volume and low volume prices, as well as value areas are displayed. The simplest and one of the most useful bits of information we gather from these profiles depends on where the market opens and closes. A settle above the open is considered positive, which is also a candlestick principle. Logically, there are degrees of power at closing time. If a market settles above the open, it is considered positive. Then wouldn't it be more positive if the settle was also above the high volume price? And for that matter, even more constructive if the close was above the fair value area. And of course the opposite is true. The degree of selling power could be tracked as well, depending on the close relative to the open, high volume price, and fair value area. This is just one way to determine momentum. Let's get back to constructing macrographs, and I'll talk about some of the redeeming qualities as we move along. This chart shows all the profiles on the previous slide, but now they are compiled into weekly bell curves. The overall structure displays the open, high, low, and close for the week, in addition to the high volume price and value area. The colors allow us to distinguish days, and the color codes are shown at the bottom of each chart. Back in the day, I can't believe I said that. I sound like my grandpa. Anyway, some time ago, markets traded only during regular business hours or specified times by the exchanges. Now that many markets trade around the clock, some of the old technical rules and strategies are far less effective. It would be nice if analysis was cut and dry with specific time frames, but tracking price action is a 24-hour job, and global fundamental events often impact prices while we sleep. So I designed MacroGraph to create bell curves in the usual time frames, day, week, month, quarter, and year, but I also wanted to be able to display user-defined time frames and composite profiles. In this example, I've taken the two profiles from the previous slide and stacked them together. By doing this, fair value becomes more defined and the high volume price more pronounced. I believe momentum begins and ends at high volume prices, so I like to create macrographs in many time frames because it can enhance timing when entering or exiting a trade. Let's take a look at 10-year note futures from a day view out to years and see how a story unfolds. In this chart, there are 3 weeks of trading divided into 15 color-coded day profiles. Under each profile, length and width dimensions are displayed, and the median measurements of all the profiles are shown in the lower left of the graph. When I look at this chart, I get no clear read on direction or momentum. Price action is choppy and trendless. But when the days are compiled into weekly structures, normal bell curves materialize and price action appears to be more organized. What seemed like disorder now makes some sense. The obvious clues that this chart reveal are that the value areas are slightly higher each week and the closes are above the high volume price as well. Consequently, bulls have momentum in their favor and long positions should continue to pay. Let's take those 3 weeks and stack them on top of each other. Now we are looking at a developing profile for the month of November. What can we learn from this? We know the fairest price of the month thus far comes in around 175.80. From that we can calculate the fair value area, which is shown as roughly 125.50 to 126.10. In the lower left corner, the range from high to low is shown as 1.18 points, and 90 reflects the time spent at the high volume price. These measurements will make more sense in the next slide. It is apparent that buyers are in control of momentum because, as the colors illustrate, higher lows are being made each week and the closes above the fairest prices. In this slide we see monthly profiles for all of 2014, but let's focus on November. Remember, we were 3 weeks into it on the last slide. Now, here's the same profile with another week added on, and it is obvious that bulls are still in control. Remember the measurements before the red or 4th week began? Well, the green box represents the length and width of an average month. By the 3rd week, time at the high volume price had already reached the norm. At the same time, the vertical range was far short of average. The point is that odds favored a directional move. There is no holy grail or perfect technical tool. The best we can do is to get probability to work in our favor, and it sure helps if we keep tabs of the dimensions in different time frames. Let's zoom in on November. Notice in the chart that the low in the 4th week came in around the high volume price from the previous 3 weeks. I mention this because longer term profiles are very helpful when searching for support and resistance areas. Old very low volume and high volume prices tend to provide support in a falling market and resistance in a rising market. We have viewed days stacked into weeks and weeks into months. Now let's take each month and compile them into quarters and years. In this chart, every month is assigned a color. When I designed MacroGraph, I wanted the colors to be consistent for different time frames. This way it would be easy to read momentum no matter what time period you were researching. Notice Monday, the 1st week of the month, and January are the same color purple. Just as Tuesday, week 2, and February are orange. Wednesday, the 3rd week, and March are always blue. Red represents Thursday, week 4 in April, and Friday, May, and week 5 are always shaded green. Note that when you get back to June, the same color scheme repeats with a slightly different shade. Only December is black, and that makes it easy to see the close at the end of the year. Once you get familiar with the first 5 colors, it becomes easy to read momentum over any time frame. I look at quarterly profiles at least once a week. I use them when looking for support or resistance levels, which are commonly old low volume and high volume areas. I think it is important to check the dimensions to see if a consolidation phase is likely, which would promote a mean reversion type strategy. On the other hand, the measurements of length and width might reveal if a market is ripe to run or break out into a trend. In this slide, you see yearly profiles, and I show this because it is proof that patterns repeat in all time frames. Bell curves are used to organize price action into structures that provide us with more variables to design strategy, calculate odds, and recognize patterns. When I look at profiles, I think of them as price bars under a microscope. As we zoom in, we find more dimensions for research. Of course, there is the open high-low close, which is available with every technical tool, but bell curves allow us to determine high volume levels and reveal where bulls and bears agree on price most often. Low volume prices show us where buyers or sellers gain control of momentum. We can calculate fair value areas, which help us define risk, and we can measure time at price, which can enhance timing when entering or exiting a trade. There is a wealth of information in each bell curve. Markets give us all the information we need. We just have to learn to listen, interpret, and react. As I contemplated how to introduce MacroGraph, I thought it imperative to tell you that I created it to be a universal tool, a tool that is valuable for day traders as well as long-term investors. It was fashioned to satisfy the needs of the seasoned trader and the novice investor. My mission is to provide the education and charting software that vividly illustrates patterns, displays valuable statistics, and is an integral part of any trader's toolbox. I struggled with a way to showcase MacroGraph without having to teach the original principles of market profile, which was strictly meant to be a short-term or day trading tool. I had an epiphany while I was reading a story about the Hubble telescope, which allows us to see deep space from the Earth's atmosphere. So rather than view space from Earth, why not view Earth from space? In other words, let's take a long-term view of markets where it takes months or even years for a pattern to develop and work our way down analyzing markets in shorter time frames using the same logic. For example, if you view Earth from space, you can see that the coastlines are relatively smooth. But as you zoom in, these same shorelines show more definition and detail. And by the time we get to where I am, in Chicago, we see detail down to words at the CBOT. In scientific terms, these are called fractals. A fractal is a repeating geometric pattern and is a fragmented shape that is a smaller copy of the whole. I believe markets have these same characteristics. In other words, patterns repeat in all time frames and in all markets. So let's step back and view some markets using yearly profiles or from what I deem as outer space. The point is to illustrate the most common structures. Markets move and coil, or trend and consolidate and repeat that process. So rather than trade markets that don't make sense, why not look for repetitive patterns that do make sense? This graph shows the S&P 500 index by year. Note the formations as well as how often the old high volume and low volume prices provide support or resistance. Notice in 2007 how the market coiled up and settled in neutral territory before getting slammed in 2008. Neutral price action is common before trend reversals. Also note that the closes since 2008 have been within fair value or higher, and that trend remains intact 6 years in running. This is a look at corn by year. I chose this to show how old low and high volume areas provided reversals when they were retested. The high for the first 5 months in 2012 came in when corn tapped the high volume price from the previous year. The high and low for 2013 formed near the two highest volume levels from 2012. And the high in 2014 was set at the lowest volume prices of 2014. Now take a look at gold by year. Back in 2006 and 7, it spent 2 years coiling around $750 before taking off to record highs. Also note that in 2012 the market revealed that it had lost momentum by developing a below average vertical range and had spent above average time at the high volume price. In other words, it was ripe to trend, and it did move lower throughout 2013. It is common to see a normal bell curve after a trend, and because the range in 2013 was far above the standard, odds favored a period of consolidation, which is a type of profile that developed in 2014. Most, if not all, professional traders want to know what is normal. If we know what the standard is, we may also recognize what is uncharacteristic. A speculator's strategy may be to react only when a market is temporarily overbought or oversold. This is commonly known as a mean reversion type strategy. A trend trader would be more interested in a market that is wound tight or in a consolidation phase for an abnormally long period of time, which increases the odds for a breakout or directional move. Many option traders compare historic to implied volatility to determine opportunity. And spread traders look at differentials that may be historically too wide or too tight. To be a profitable trader, one must choose a style and identify the opportunities. MacroGraphs were designed to illustrate all the variables a trader needs to create a plan of attack. Let's consider the view of gold by year as a view from space. Now let's narrow that focus by looking at quarterly profiles. Before this market broke down, there were signs of neutrality in the fourth quarter of 2012. And sellers made a statement early in 2013 when they pushed the market below the high volume prices of the previous year. They've been in control ever since. Now let's zoom in using monthly profiles to see what was happening before gold broke down. Notice that the highs were made early in the monthly profiles and that the closes were below the high volume prices. Also note that the high volume prices from the previous months provided resistance when retested. An even closer view of the weeks before gold broke down shows a market that was confused and trendless. Such price action is frequent before trend changes. The biggest clue here is the below average vertical range and above average horizontal count or time at price during the week of February 4th. Now let's narrow the spotlight even more with daily profiles. This market was wound tight or stuck in neutral just before sellers took a stance on Monday, February 11th. The elongated profiles are highlighted. They are called sprints or trend type days, and they are common at the onset of trends. We have covered profiles from a day out to a year and a year down to a day. I believe to be a successful trader, it is best to have a long-term perspective or opinion and use short-term signals to verify if the conditions or odds are right to make the trade. It has been over 30 years since I saw my first daily profile and over 25 years since I constructed my first MacroGraph. I still enjoy viewing the charts today. Each weekend I create over 100 charts for many commodities and indexes using an assortment of time frames. I have viewed countless profiles during my research to find repetitive setups that increase my odds for profitable trades. In fact, I designed a checklist of variables that must be addressed before making a trade. This list originated out of necessity when I was a broker filling orders for traders from all over the globe. It is comprised of the most common questions traders would ask on a daily, even hourly basis. I broke them down into an easy-to-remember acronym called Vertex. The V in Vertex stands for value and answers the question of where buyers and sellers agree on price. If we know what fair value is, we can determine the second variable, which is E for energy, or who controls momentum. Remember, momentum begins and ends at high volume levels. R represents risk and is determined using value areas and sprints. T stands for timing. Is the market ripe to run, or is it best to counter trade? We use vertical and horizontal dimensions to determine that. E is for entry, or support resistance areas, which we know tend to come in at high volume and low volume prices. X stands for exit and is simply projecting how far a market is apt to travel and how to lock in profits during a trend. I designed my lessons and MacroGraph to display all the variables a trader or investor should address in order to make quality trade decisions. When I used to day trade, I could only truly concentrate on a few futures markets, so I focused on 30-year bonds, 10-year notes, and one or two of the equity indexes. When those markets were quiet, I sometimes took a look at a metal or an energy, but I rarely traded them. Unfortunately, there were many days that I traded for the sake of trading. I figured, hey, I'm at the crap table, might as well roll the dice. I quickly discovered this to be a costly approach. I had to accept that there are just days or patterns that do not make sense or give me an edge. I learned that you cannot force opportunity, so I spent my time preparing to take advantage when an opportunity presented itself. So I changed my approach. Rather than overtrade a couple markets, I decided to search many markets for a few repetitive patterns. And to increase my odds of finding opportunities, all I had to do was search for those same patterns using multiple time frames. Russell Wilson, quarterback of the world champion Seattle Seahawks, put it in perspective. This is not a direct quote, but it is the essence of what he was trying to convey. People say, Russell, you are so talented. But I say my talent is a result of years of practice, and attempt after attempt, day after day. Preparation and practice develops talent. Years of perseverance and practice and watching countless scenarios play out help me choose which patterns produce the best odds for profitable trades with reasonable risk. With enough practice, you will be able to recognize and react almost instinctively to situations while under pressure, much like a professional athlete. My mission is to give you the tools to think like a professional trader, because that is who you'll be competing with. If you'd like to make your own macrographs, register on our website and I will set you up for a trial. To learn more, check out our videos, publications, and FAQs on the site. If you have questions, please contact me via email. Thanks for taking an interest in MacroGraph. Good luck and good trading.